Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Steve Sosnick, chief strategist at Interactive Brokers, to discuss the impact of stock splits on the affordability of options. We'll also take a look at the jobs data as well as investing like a value investor. It's great to see you, Steve. Welcome back to Trade Talks.
Always my pleasure, Jill. Great to see you too.
And this market just cannot string together more than one green day. We had the jobs data this morning. Is that a reflection of why we're down over 2% on the Nasdaq 100?
Well, I mean, this is volatility. What we saw yesterday was what I like to call socially acceptable volatility. Today we went down and it's not socially acceptable volatility, but it's volatility none the same. Volatility, as we've discussed, counts in both directions. The jobs numbers, though, seem to be uniquely unfriendly to everybody, which is kind of odd because they're actually decent numbers. We added more jobs than had been anticipated, substantially more. There was a positive revision upwards, but in a market that's driven by concerns about Fed liquidity and inflation, this is not what we wanted to see. It wasn't. It was solid enough that the Fed won't change their mind because regarding full employment, this is a good picture. Unemployment's low. All this is great if you're the economy. It's not as good if you're a market that's kind of dependent upon Fed liquidity. And this does nothing to dissuade the Fed from raising 50 basis points sequentially for the next few meetings. And that led to higher bond prices and a lower NDX, among other things.
Yeah. Well, it makes you wonder if we actually do. Right.
Sorry.
If we do actually get a recession, that could potentially be a good thing for the market because the Fed is going to dial back a bit. It's very counterintuitive. That balance is just so tricky between the economy, what the market wants, where interest rates are, where inflation is, where jobs are. It really is a lot to unpack. And I think it's one of those situations where it's going to take some time to work through this volatility and work through those issues. I want to take a moment and talk about stock splits. And my question to you is, are they fundamentally meaningful to a company's business or balance sheet or to an investor?
It's your question is really well timed with Amazon going X-split on Monday, 20 for 1, which will impact a lot of people who are presumably watching this. To me, stock splits are the equivalent of making change. If I've got a $20 bill and I need singles, at any given point, I might find it more economic utility from having 20 singles, if I have to give out tips or something like that, than a $20 bill. On the other hand, there may be times I don't want 20 singles because I don't want it taking up all my space in my wallet. That's really what a 20 for 1 split is. The old logic was that it made a stock more affordable. But that's not really so much the case anymore in this era of fractional shares. If you can't afford a full share of Amazon, which is expensive, $2,400, you could buy a fractional share at a wide number of brokerage firms. And so that's not really an impediment to ownership anymore. Sure, I think many people would rather own full shares, but in this era where there's no distinction between odd lots and round lots, with one big exception that we'll get to, of course, there's really no fundamental reason why it should affect a given stock, unless you're an options trader. That's where it makes a big difference. And because options still do trade in 100 lot increments, that is your multiplier. Every time you buy an options contract, it's a contract to buy or to sell 100 shares, typically, of the underlying product. The thing here is, because the 20 for 1 split will cut the strike by a factor of 20, and it will basically cut the price of the individual option by 20. So if you found an individual option somewhat unaffordable, let's say an at-money option might cost you $10 a contract, which is $1,000, which may not be something you're comfortable doing, well, that'll get cut by a factor of 20, and so you will find it much more possible and much less economically onerous to trade options on the stock. This isn't necessarily a plus or minus. This isn't a recommendation to go say let's trade Amazon options after the split, but it does mean that you will have some greater affordability if you are an option trader. It will give you many more options, for lack of a better word.
You wrote a piece in Barron's that I thought was quite interesting, titled "We're All Value Investors Now." Essentially, the distinction between growth and value is gone. Tell us more about that.
Yeah, we got so engrossed in the cult of growth, and I will say that benefited a lot of the NDX complex, because Nasdaq has so many fast growing stocks. But I think that we kind of got carried away because the easy money and the environment got us to the point where a lot of people were really overpaying for growth and not really considering value. Well, for better or worse, a lot of those stocks have come back to earth. The values sub-index of the S&P 500, for example, and the growth sub-index are essentially identical in terms of returns since the start of COVID. And so this gives us an opportunity to reset in terms of your growth stocks. Some of your growth stocks really were overpriced and deserve to get whacked. A lot of other great growth stocks got whacked and now present values. Yes, they're value stocks. And in the article, which you can read either online now or will be in the paper this weekend, you'll be able to see that I looked at Qualcomm, which is a great tech stock. It's not necessarily the fastest grower, but they churn out earnings and cash flow every quarter, and the market is treating it as a value stock right now. This is the type of name that you could be thinking about. In the article, I gave an example of being a secured cash secured put writer, which is one way to approach it. But there's many different ways. But I think in general, the lesson we want to take away is for a lot of the popular growth stocks, they're at value prices, and those do present great opportunities for a lot of investors.
They certainly do. Steve, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.